So the purpose of this video is to talk about one of the most common problems that comes up when you are applying for a loan modification that can cause you to get a denial, and that is miscalculation of your income or expenses. So I'm just going to kind of walk through that and let you know kind of what you can do on your end to make sure your application goes forward smoothly. If you're already a subscriber to my page, good to see you, welcome back. If not, try to like the video, let me know if you have a comment or question, subscribe. That really allows me to get this information out to as many people as possible. So one thing that will cause a loan modification denial is if the bank miscalculates your income and expenses. So as we know, as part of the loan modification process, you're going to be asked to verify your financial situation. They're going to ask you to send in pay stubs if you are a W-2 employee, or a profit and loss statement if you're self-employed, if you receive Social Security income or retirement income or some other sort of benefit income, disability income. You'll be asked to send in an award letter kind of verifying what this income is. If you want more information around the actual loan modification documents that are required, there are tons of videos on this page about that. This video is related to a particular problem that can cause a loan modification application to get denied. And that happens when the bank miscalculates your income. So I think it would come to no surprise to anyone working with their bank that these banks make mistakes, right? They have tons of files, tons of people working for them. They're not paying close attention to your particular situation. It's not like you have one person on your end who sits down every day with your file and really tries to understand what's going on. They're moving quickly, and sometimes income can be a little bit complicated, especially if you're not paid in a straightforward way. So the first kind of mistake that can happen with miscalculating the income is the bank will miscalculate your income as being too high, right? If your debt to income ratio makes it look like your loan or your mortgage payment was super affordable to you, meaning like if you show the bank a tiny amount of expenses and a huge amount of income, the bank may not believe that you have a valid financial hardship that caused you to default in the first place. They might look at your income being really high and your expenses as being really low, and they might say, hey, these people did not have a valid financial hardship. They could have sustained a mortgage payment, and so they might deny you on the basis of what's called affordability, meaning they think that your income does not support any sort of financial hardship. Again, if you want more information on like debt to income ratios and what I'm talking about there, watch the front end, back end debt to income ratio videos that I posted. This is just about kind of income causing a problem. So one of the ways that banks will miscalculate your income too high will happen when they take some sort of inconsistent income that you received on one of your pay stubs, and then they apply it to all of your income. This is most common with people who receive a one-time bonus or a one-time commission, or sometimes there's like a holiday payment that everybody receives in December to kind of boost their income. Now, if it's a consistent type of bonus, meaning if every month that you work, you can expect to rely on this bonus money or this commission money, that should be included in your income. But a lot of times I see homeowners who have a weird one-time payout that is not part of their regular income. It just so happens that they received the payout during the month that they're being asked to provide their income. So, if your employer says everybody's getting a one-time, $3,000 bonus, this is not consistent, we're giving it one time because everyone met their numbers, you can't rely on it moving forward, but the pay stub that you show the bank has that additional bonus income attached, the bank might think that you get that every month, and then they might put your monthly income into their calculations as whatever your base monthly income is plus that one-time bonus. So you need to be careful if you're presenting income that has something attached to it that would make it skyrocket. You want to make sure you either include a letter of explanation, there's other videos about how to do that, or include multiple pay stubs that expand beyond that 30-day time frame. I would recommend doing both things so that the bank can see that they should not be including that regular or that irregular amount of income with your income calculation. You need to tell them this is a one-off thing that does not come into the household regularly. On the flip side, banks are going to, at times, make a mistake because they're going to miscalculate your income too low. So if you are the type of employee if you're a type of employee who has fluctuating income, or often if you're self-employed and your business is seasonal, your income is going to be very high some months and very low other months. And so you can cause an issue for yourself if the bank says, hey, just send me a profit and loss statement for your business for the most recent 90 days. If your most recent 90 days days are very, very low, meaning it's not your high season, the bank will think that that is the income that should be expanded to reflect your entire income forever, and they might think that you can't afford to resume making a mortgage payment. So what you need to do in this situation is understand that that's how it will be perceived, and make sure you provide either a profit and loss statement or additional income information to show that that period of time is not regular and that there are other months happening where you're earning more income. And you can kind of see how that works on the flip side too. If you provide a profit and loss statement for your peak most seasonal month where you make 3 times your normal monthly income, the bank might think that that's your regular income, and then they might apply that to your calculation and they might deny you because your income is too high. So if you are watching this and you know that you have additional things added to pay stubs, or you have a business that fluctuates, you need to go watch the video on this page that talks about profit loss income and how to kind of work with your numbers to make sure you're giving the bank an accurate portrayal of your income so that they don't miscalculate your income. That's very common. The other way that banks kind of miscalculate income is if they see a large deposit coming in on a bank statement that they don't have an explanation for, they might include that as part of your income. And so an example of this would be the bank asks you to provide 60 days worth of bank statements. You have to do that. It's part of the financial package. Let's say you received maybe a one-time gift from someone in your life who gave you $3,000. That's great. You're allowed to do that. And that $3,000 is showing is deposited on your bank statement. If you don't explain that to the bank will just see a random deposit of $3,000 and they'll think, oh, this person has another source of income where every month they receive $3,000. And so that will cause them to make a mistake in calculating your income, and that they'll add that to the income, and then they'll think that you have this very high income and it might cause an issue with you getting approved. So if you have one-time deposits coming into your bank statements that are over $500, my general rule is if it's over $500 and it's not a consistent source of income, always include a letter of explanation and tell the bank, what is this income? And make sure you tell them it's not consistent income. Do not include this in my income calculation. You cannot rely on this. And if you want more information on how to write a letter of explanation, there's a video posted somewhere on this page about letters of explanation. So you need to be careful that if you're presenting income that's a little bit complicated to understand, you're presenting enough income for the bank to get a full picture of what you actually have going on. The other kind of part of this where banks make mistakes is they miscalculate your expenses. And again, this miscalculation can go in both directions. They can think that your expenses are too high, meaning you have so many expenses going on that there is no way that you can afford to resume making mortgage payments, which would cause a denial. Or they'll think that your expenses are so low that they won't think you have a valid financial hardship, meaning you should never have defaulted in the first place. And then they're going to deny you for what's called affordability, again, meaning we don't believe you that you should have defaulted. We think that you should have paid this, and thus we're not going to give you a second chance. So these are kind of the common things that happen with expenses, right? So if you have things showing up on a credit report that show as active lines of credit that have actually been paid off or closed or done with, sometimes what I see is banks pull your credit report, but the credit agencies that do the credit reporting have not reported accurately. And so one way is that expenses can get raised very high is if the bank pulls your credit report, which they likely will do, and then they think you're paying on maybe 3 different open credit accounts. If you know that those are closed, it's your job to communicate that to the bank and to provide proof to the bank that they are in fact closed. So what you need to do as your loan modification review is going on is you need to be asking the bank, can you tell me what expenses you're using? And you're going to hope that they're just using the expenses that you reported. But your bank should be able to give you a list of here's the expenses that I'm seeing, here's where they come from. If you see expenses that come from your credit report that you know are closed, you need to go to that creditor, get the proof again that you paid off that account, and you need to send it to the bank so they remove those expenses from your review. So sometimes what I'm trying to say is sometimes the credit agencies aren't caught up and they're still reporting that something's open, especially if you've paid it off relatively recently. So that's kind of your job to make sure that your servicer has accurate information about what's showing up on your credit report. One of the ways that expenses can be miscalculated too is if you have a particular month where you just had like a huge one-off, one-time expense. So this goes back to the bank statements. So the bank will ask you to provide 60 days worth of bank statements. Let's say you paid for a roof repair one month and that cost you $7,000. The bank will see an expense going out for a repair to the home at $7,000 from your bank statement. They might assume that that's a regular expense that you have coming in every month, and they might add $7,000 to your expense sheet, which is a huge expense. So you need to tell the bank that that expense going out is a one-off expense that does not occur every month and is fully taken care of. So basically, you should be auditing your bank statements and seeing what the bank might see as an expense, and then you need to decide, is that a regular expense that should be included in my expenses, or is that an irregular expense that I need to tell the bank not to include? So as I say, the general rule is if your expense is over $500 and it's a one-off expense, you need to write a letter of explanation and clarify that for the bank right at the beginning of the process so it doesn't cause you to get denied. So just to sum up everything here, there can be issues that can cause denials with your loan modification review related to your income. They can miscalculate what you have coming in. They can miscalculate it in ways that are too high or too low. They can also miscalculate your expenses. They can see things that don't exist, making your income too high, or they can miss things that make your expenses look too low. So you really want to understand what you're aiming for when you apply. You want to have good, solid debt to income ratios. Watch those videos. If this video is speaking to you, watch the debt to income ratios to make sure you understand what you're trying to communicate to the bank, and then take responsibility to look at your own documents before you submit to try and get out in front of any of the issues that might cause your income calculations to be kind of weird and inaccurate. If you get denied because of an income issue that you believe is inaccurate, you will have 30 days to appeal your denial with the bank. There's other videos posted here about kind of how to do that appeal process and what to do and how to make it clear. But you don't want to be fighting these issues on appeal if you can avoid it. So try to be aware of them at the outset and just do the best that you can to make clear what is actually going on and what is not going on so the bank doesn't have a problem and miscalculate your income. Good luck.